Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at POIT technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Right. So the big picture here, the real challenge everyone in AI is facing is how do you power these massive models? They're just so power hungry. And you can't create this huge bottleneck with heat and energy consumption.
That is the core problem. And that's where a company like this comes in. They're an AI connectivity provider. And, the reason for all the attention is their core intellectual property. It's their big competitive moat. The patented optical interposer platform.
Okay, let's stop right there because optical interposer just sounds like, heavy engineering jargon.
It does.
But it feels like this is the whole story. Can we translate that? What is this wafer scale heterogeneous integration and why on earth does it matter so much?
Of course. So think about how chips are normally made. It's like you have 5 different factories making specialized parts, your silicon, your lasers, detectors, electronics.
Right.
And then you basically have to glue them all together on a circuit board one by one. It's bulky, it's slow, and you lose a lot of energy.
A dirt road for data, essentially.
Yeah, exactly. A dirt road.
Yeah.
So the optical interposer just flips that entire model on its head. It lets them integrate all those separate parts, the photonics, the light sources, the electronics, all of it, seamlessly at the wafer level.
Before they even cut the chips out.
Before they even cut the chips, they've essentially built a miniature superhighway for data right into the foundation.
Wow. So they're building a tiny little factory inside the chip itself.
Precisely. And doing that integration at the wafer scale, it delivers 3 things that are just non-negotiable for AI data centers. You get superior speed, you get much lower manufacturing cost, and you get huge gains in energy efficiency.
And when you're running a data center that uses the power of a small city?
That's the primary goal, cutting energy. The interposer solves that physical barrier.
And this isn't just theory anymore, right? We have some real external market validation for this. I'm thinking of the big acquisition of Celestial AI by Marvell.
Yes.
Celestial AI was a customer using this exact technology.
That deal is a massive stamp of validation. Huge. It proves 2 things. 1, that the tech is not just viable, but absolutely necessary at scale. And 2, it creates these incredibly high switching costs.
How so?
Well, if a giant like Marvell is willing to spend that much money to buy a company already using this platform, it tells you that the traditional semiconductor foundries, they have a really steep multi-year climb to try and replicate this. The moat is real.
That's a powerful technical story. But, great tech doesn't always equal a great stock. So how messy are the financials right now? Because that's usually where the story gets complicated.
It is the classic high-risk, high-reward conflict. We have to be honest about the near-term picture, which it definitely gave the bears some ammunition recently. The Q3 2025 results. They were a revenue miss. The company did about 0.3 million against a consensus of 0.55 million. And the EPS was negative at minus 11 cents.
That's a big miss. I mean, that's nearly half of what was expected. So if you're an investor, how do you weigh that?
You have to see it in context. This company has been in what's called the non-recurring engineering phase. Prototyping.
R&D stuff.
Exactly. So those misses reflect the lumpiness of R&D projects, not a failing business model. The key is what happened right after those results. That was the real catalyst, the inflection point.
The signal that commercialization is here.
That's it. They get a $5 million production order for their 800G optical engines. This is the moment they switch from one-off engineering projects to actually manufacturing a recurring product for AI data servers.
And 5 million might not sound huge in the world of big tech.
But for this company, it is everything. It's proof. The product is qualified and commercial shipping is starting. That's what moves the needle.
Okay, so if we look at the balance sheet, which is so critical when you're scaling up manufacturing, I was surprised. The numbers are actually pretty strong.
They are.
They're carrying 0 debt. 0. That gives them a ton of flexibility.
And look at the gross margins. Even on those non-recurring engineering projects, they were pulling 61%. That tells you something very important about the potential once they get to volume.
Right. It shows the core tech is inherently profitable.
Immensely. As that 800G engine order scales up, that profit potential should be massive once they cover the fixed costs.
But you need cash to scale. Lots of it. And they're not cash flow positive yet. So where's the funding for this big push coming from?
And that brings us to the strategic funding. So in October 2025, they closed a $75 million investment.
Okay.
And this wasn't just for general operations. It was specifically earmarked to fund this AI connectivity growth, this cash. It's a necessary evil, you could say. It helps manage the risk of that negative EBITDA and cash flow you see during a big production ramp.
So the negative cash flow is actually expected at this stage.
It's a sign of investment in future growth, not a sign of failure.
So they have the cash, the validated tech, the first big order. Now, it all comes down to execution. Can they actually build these things at the quality and volume the hyperscalers need? That feels like where the whole investment case rests.
It is the absolute key risk, no question. The plan is to ramp up production at their facilities in Malaysia, and they're partnered with an expert manufacturer, Globtronics, to do it.
And the target is pretty aggressive.
Incredibly aggressive. They're projecting capacity to exceed 1 million optical engines a year.
1 million units, wow. What's the biggest challenge there? Is it the supply chain or getting the yield rates up on such a complex product?
It's both.
Right.
It's primarily yield and complexity. Going from custom engineering to a high-yield, high-volume process for optical parts
Right.
is notoriously tricky.
Right.
Partnering with a company like Globtronics is meant to de-risk that. But the
Yeah.
market will be watching those yield numbers like a hawk as they scale up.
And while they're scaling the 800G, they're not standing still. The pipeline is already moving to the next generation. I saw the partnership with Sumtech for 1.6T receivers. They're already sampling.
Yes, and that jump from 800G to 1.6T is critical. AI compute power doubles, every 18 months? Data centers have to double their bandwidth just to keep pace. 1.6T isn't a luxury, it's a requirement.
So the Sumtech partnership shows they're staying ahead of the curve.
Exactly. And then you look even further out to something like co-packaged optics, or CPO.
The PoE Blazar.
That's their external light source for CPO and chip-to-chip AI links. CPO is sort of the holy grail for data centers, where you integrate the optics right next to the main chip. By developing this, they're positioning themselves for the highest value part of the market, not just the pluggable transceivers.
Let's go back to the risk for a second, though. They had to raise that cash, and that means dilution. There was a share sale of nearly 30 million shares, and cash flow is still negative. Is that a red flag?
It's a calculated risk, a necessary one. If they didn't get the capital, they couldn't fill the orders. So you have to see the $75 million raise and the $143 million shelf registration as defensive moves. They're getting the liquidity they need before the huge orders come in.
So short-term pain for long-term gain.
That's the thesis. The dilution now gets overcome by the massive profit potential later.
Okay, let's switch gears. Market sentiment. The technicals have been looking exceptionally bullish lately.
Very strong.
The stock is trading above both its 50-day and 200-day moving averages.
That's a very strong technical setup. It confirms the recent momentum. You hear analysts talking about a potential golden cross formation, which suggests the rally has real strength. And we saw that huge surge, almost 15%, when an analyst raised their price target from $7 to $8.
The market is clearly sensitive to any news.
Highly sensitive.
What about the options market? That's usually where you see what the smart money is betting on.
It screams bullish conviction. Call volume is way up, almost double the expected rate. People are making aggressive bets. But what's more telling is the high implied volatility, over 110%.
And that's on longer-dated options.
Specifically on longer-dated strikes. We're talking the January 2026 $7 strike and the January 2027 $10 strike.
Okay, what does that mean in plain English?
It means the market is pricing in a massive price swing in the future. Investors are betting that when the company finally delivers on this manufacturing ramp, the stock will move violently to the upside. They're willing to pay a huge premium for that bet.
And of course, with a sector this hot, you always get the M&A talk.
It's rampant. After Marvell bought Celestial AI, a validated customer, the speculation it ramped up that this company could be next.
It makes sense?
It does. With their proprietary tech, any big semiconductor or cloud player looking to secure their spot in optical interconnects would see them as a prime target. Especially with the whole AI data center market forecast to grow, 19 to 22% a year? They're right in the middle of that wave.
So let's nail down the dates. When do we get the next report card on their execution?
The big one is coming up. Q4 2025 earnings. The market expects that around March 30th, 2026.
And after the Q3 miss?
The focus will be laser-like. No one's going to care about historical results. It will be all about execution. How much of that $5 million 800G order has shipped? And what's the latest on the 1.6T sampling? That's it. Execution is what will change the valuation.
So to sum it all up for our listeners, what's the final thesis? You've got this revolutionary tech solving a huge problem. It's validated by real orders, and it's backed by a $75 million war chest. This feels like the definition of a high upside play if they can just stick the landing.
It's undeniably a high-risk, high-reward setup. The whole bull case, it all comes down to that transition from R&D to mass manufacturing. If they pull it off, the tech and the cost advantages of the optical interposer pretty much guarantee a massive upside.
And the time horizon. Is this a quick trade or a long-term hold?
I think you can see it both ways. With the options flow and the technicals, it's definitely set up for a potential swing trade into that March earnings report. But the core thesis is a multi-year hold. It's all based on that production ramp starting now in the back half of 2025 and really accelerating through 2026. That's where the real value gets created.
So a final thought for you to chew on here. It's about scale. The exponential growth of AI demands connectivity that's faster, cheaper, and uses less power than anything we have today. So the question you should be asking now is this. When you see those aggressive targets, like 1 million engines a year, is management betting the entire company on success? Or are they setting themselves up for a spectacular failure if that ramp stutters even a little? Keep that risk in mind heading into March. And for more talks like this, be sure to subscribe.